In Lesson 1-2, we are going to talk about how business activities change the accounting equations. Our learning objectives, we will classify accounts as assets, liabilities, or owner's equity, and demonstrate the relationship in the accounting equation. We will analyze the effects of transactions on the accounting equation, and we will distinguish between cash and on-account transactions. The business we'll be talking about in the first unit of this book is Delgado Web Services. Michael Delgado, he designs his own personal websites as well as websites for some friends. The father of one of his friends runs a plumbing business. He asked Michael if he could design a website for the plumbing business. After the website went live, the plumber's business increased by 25% in the first 6 months. So Michael realized he might be able to make a career from designing websites. Now, a couple of different types of businesses here. The one we're going to talk about in the first unit is service businesses. That is a business that performs an activity for a fee. Our example here would be Delgado doing web services. And he is a proprietorship. That is a business owned by one person. It is sometimes referred to as a sole proprietorship as well. There are some advantages and disadvantages of that. With a proprietorship, the owner is legally responsible for all debts, taxes, and losses. Therefore, if your business were to go bankrupt, the bank could go after your personal assets as well as the business assets. However, it's easier to set up than to create a corporation as well. Now, a business plan is a formal written document that describes the nature of a business and how it will operate. You need to create one of these before you start your business. You will also need it before you get a loan to start your business. The standards and rules that accountants follow while recording and reporting financial activities are commonly referred to as Generally Accepted Accounting Principles, or GAAP. GAAP helps ensure that all companies follow the same set of guidelines and practices when reporting financial data. Following GAAP principles and concepts ensures consistent reporting. One of the gaps that we will talk about will be unit of measurement. That is when you use the same, basically the same currency throughout all of your reports. So for unit of measurement, that would be using US dollars in all of your financial reports. Even if you did business in another country, we wouldn't switch between different types of currency. Another one that's important is business entity. This is when we need to be careful to keep accounting records separate from your personal life and your business. So business entity is implied when a business's financial information is recorded and reported separately from the owner's personal financial information. The accounting equation is super important and always needs to be in balance while we work throughout our accounting transactions. Now, financial rights to the asset of a business are called equities. A business has two types of equities. The first one is equity to those whom money is owed. For example, we could buy supplies from a company and then we would pay them at a later date. That would be an example of one. Or we also have the equity of the owner. That would be the person who invests in the assets of the business. So therefore, if you go ahead and invest in your business, that would be your owner's equity. That's the amount remaining after the value of all liabilities is subtracted from the value of all assets. And our accounting equation is the equation showing the relationship among assets, liabilities, and owner's equity. So here's our accounting equation. On top of our T, we have assets, which is the left side amount, need to equal the right side amount, which would be our liabilities plus our owner's equity. And this will always be in balance throughout all of this book and everything to do with accounting. Accountants call any business activity that changes assets, liability, or owner's equity a transaction. A record that summarizes all the transactions pertaining to a single item in the accounting equation is called an account, and every account is given a name called an account title. Now, the difference between an increase and decrease in the account is called the account balance, And an account used to summarize the owner's equity in a business is called the capital account. So there are a few different transactions we will have in this lesson. The first one here is if we were to receive cash from an owner as an investment for $2,000. Now, in this transaction here, our first transaction that you would normally have to start a business would be something like what we have here. Transaction 1. On January 2nd, received cash from owner as an investment for $2,000. Now, in every transaction, there are going to be two accounts that will be affected. And also remember that our accounting equation always has to be in balance. So we received cash from owner. Cash is going to be our account title, and cash is something of value that we own, so it is an asset. So we received cash, we got cash, so cash is going to increase by $2,000, so we would do plus 2,000. Now, as an investment, the owner just invested money into the business, so that is part of the owner's equity. And the account title we give for that is called Michael Delgado Capital. Michael Delgado would change whatever the owner's name would be, but it is the capital account, and he invested money in the business, so his capital account is increasing by $2,000. Now, looking here at our accounting equation, whatever we do to one side of an equation, you have to do to the other side of an equation. So we added $2,000 on one side, we're going to add $2,000 on the other side, so that way our equation is in balance. So $2,000 equals $2,000. Our liabilities is at 0. Now, a person or business to whom a liability is owed is called a creditor. So an example of this would be the fourth transaction. If we bought supplies on account from Canyon Office Supplies, $220, what would happen is that we bought supplies, so supplies would be increasing by $220. So we would do a plus for supplies. That's our asset account. And then the amount that we owe Canyon Office Supplies is increasing by $220. So we would do our liability, which is accounts payable Canyon Office Supplies. We would do plus $220. Our new balance down here you would see is $220 for Canyon Office Supplies. Now what happens is on the fifth transaction when we pay Canyon Office Supplies, so that one is on January 9th, paid cash on account to Canyon Office Supplies $100. We paid cash, so cash is going to be decreased by $100. And then the amount that we owe Canyon Office Supplies is also going to be decreased by $100 as well. So if we subtract $100, you can see the new balance for Canyon Office Supplies is $120. Now, there's a lot of new stuff in this lesson because this is something I doubt you've ever done before, so make sure to watch and follow along, work along on the Work Together video as well.